Good evening, everyone. Welcome to the sixth edition of the Quarterly Connect. I would thank everyone to join us who've joined us on this Friday evening. We're joined by a lot of our investors as well as our partners, and thank you for spending this time with us. We're having this talk at a very critical time as we see a significant headwinds around both domestically as well as globally. We've seen, a disruption of some supply cycles due to geopolitical events, as well as, the legacy which we had from the COVID days. You're seeing central banks across the world raising rates, inflation showing its head up. Clearly, challenges at times like this call for a discussion, which is what we want to do right now and share with you our perspectives. So the agenda for today is to really discuss performance of our strategies at WhiteOak Capital over the last financial year. We'll also talk through some of the activities, recent events in the marketplace. There have been a lot of questions which have come from our partners as well as investors on some of the performances of the schemes, and we would want to discuss those things. Just as a capsule, last time when we had met, we discussed a couple of things which had included the launch of our asset management company and the first strategy on the FlexiCap fund. Unfortunately, that had to be deferred due to some regulatory challenges which were there. And we're hoping that over the next quarter, we should be able to launch the first strategy on the mutual fund platform. We'd also shared with you all the digital leader strategy last quarter, and we're pleased to know that the strategy is up and live, and we have a lot of clients who've participated in that. So I would now hand this over to Prashant Khemka, who's the founder at WhiteOak Capital, and he would discuss both the strategies as well as an outlook which we have for this particular quarter and the coming year. Over to you, Prashant.
Yeah, so what I'm going to do is give a quick update. A lot of you have probably been on similar calls in the past, so don't want to be repetitive, but briefly go over our investment philosophy and process. Just I promise you won't take more than 2-3 minutes on that one. And then spend considerable time on performance, as we always do, but maybe a little more this time. And then talk about where the portfolio stands today, cover some, Parag would cover the recent merger announcement between HDFC Bank and HDFC Parent. We do own HDFC Bank, though we don't own the parent. And then talk briefly about the macro, right? So just a quick update about WhiteOak. Compared to last time, we are at about $5.7 billion group wide, which is 44,000 crores. In terms of employee headcount, we are now actually, maybe as of today, over 250 people as we prepare for the launch of our domestic AMC mutual funds. As Prateek noted, there are some regulatory circulars, and that's not particularly to us. Just to clarify, this affects the whole industry, and none of the industry participants are able to launch any NFOs till the industry as a whole, as I understand, is compliant with certain circulars that SEBI had put out. So we're hopeful over the next few weeks that gets sorted out and the mutual funds will be launched. But currently, the AUM of 43,000 crores is roughly split 25% from India, mostly you all on the call today, and 75% from outside India. On the total, you'll see 40% comes from institutions like sovereign wealth funds, pension plans, and so on globally. 46% comes from ultimately ultra high net worth individuals, HNIs, family offices, and so on. Again, like people on the call today. So if with that brief update about the firm, let's go and recap what we do, how we do. We'll go over performance later, longer term, near term, and whatnot. But what has helped us deliver strong performance over long periods of time consistently is our focused investment culture, what we call performance first culture. In brief, it is underpinned by these 4 pillars: team, philosophy, process, and portfolio construction, which are aligned with one another, resulting in the magnitude and consistency that you have seen in the performance in the past. If we briefly touch upon the next couple of slides upon the team has been expanding. As you can see, today it is 26 people team as of March end. We have added some more during the month of April that will leave for the next quarter's update. But we are expanding the team in Singapore as well as we prepare to launch Global Emerging Markets Fund later this quarter. That one also is in final stretches of regulatory filings, and quite likely by the end of next month or within a month should be up and running. It's a Dublin domiciled UCITS fund. So we continue to add resources, and it's going to be very powerful to have, and unlike any other team in India, to have on our own team capabilities of covering not only Indian equity markets, but covering equities in global emerging markets, 25 to 30 countries from Korea to Mexico. Something, as I've discussed in the past with you all, that I personally benefited a lot from the experience of having looked at over 2,000 companies beyond India, and the learnings from those, bringing them to bear in our investment decision making in India as well. Because most of these countries, if you think about be China, Korea, Mexico, or any country in between, from an economic development perspective, are 5, 10, 15, 25 years ahead of India. So a lot of what you see in terms of, be it, sunrise sectors, such as the new age tech companies, or even otherwise traditional economy sectors like insurance sector, which in India one can call it from a market perspective a sunrise sector, because most insurance companies weren't listed till 5 years ago. All these are companies which have been listed for a decade or longer in these other emerging markets. So having the experience and early insight into those business models do help in decision making in India as well. So very excited about the increased research capabilities, which is already most well-resourced team in the industry, and further strengthening going forward. If we go to the next slide, the shared philosophy of the team, very briefly, is that outsized returns are earned over time by investing in great businesses at attractive valuations. So the two important elements of business and value, where we see most powerful combinations where we want to be invested. In terms of business, what we like to find in our companies is superior returns on incremental capital, scalable and well managed, both in terms of execution and very crucially governance. These are all born out of the fundamental value equation, which is noted in brief at the bottom of the slide. Value of a business is present value of future cash flows. To generate cash flows, you have to have returns on incremental capital higher than cost of capital. Scalability is all about growth, whether a business can multiply relative to its peers in the industry or the economy overall. And if you have the potential for first and second, you still need, very crucially, management that can execute to deliver on that potential. And first and foremost, you need good governance. Because if you don't have good governance, then the business might be great, but only for controlling shareholders, not for us minority shareholders. In such situations, the equation that's there on the bottom of the page, when governance is not good, that equation goes out of the window for a toss, as there's no sanctity to cash flows. And hence, the best way to make money from those kind of companies over time is to stay away from them, which is something the team has done extremely well and has been a key contributor to our longer term performance. When we identify such companies, we want to then value them logically and have the discipline to invest only when there's substantial upside. While we have very strong discipline on valuation, we don't look at the most commonly used or abused metric of PE multiple, because it's distorted, misleading, and harmful for investment decision making. What we focus on is first principles based cash flow approach, DCF approach, adapted to our philosophy in what we call, as you'll see on the next slide, OPCO FinCo framework. It's an adapted version, modified version of DCF, basically, where we split the value of any company into two components. Finco and Opco. Finco is the value of the dump capital in the business, the invested capital. Opco is the value of excess return on invested capital in the business. Various companies within the same industry may have a very different split. And if the split is not properly analyzed, then at a combined level, one can be very misled by P multiples based valuation approaches. We split the value and assess them on cash flow basis, DCF value, as well as the price to excess ROIC multiple of Opco, which we believe leads to more apples to apples comparisons and serves as a logical input to decision making rather than a distorted input, which PE multiples are. With that, I'm going to skip for now the other aspects of our investment culture and jump to performance. As you all who've attended in the previous sessions, we do spend time analyzing performance, and we want to probably spend more time this time around, as this time the performance has been negative. So we don't want to gloss over performance, but instead go take a deeper dive to help you understand the performance and why it has been so. If we stay on this slide, you'll see that year-to-date performance has been negative alpha of over 300 basis points, but over prior years, it's been consistently positive, and since inception, annualized 23% return compared to 17 for 600 basis points of alpha. This is over the last 3 years, net alpha, which makes it one of the top performing strategies over 3 years, which includes the most recent underperformance. If we go to next slide very quickly, there are a lot of attribution analysis, and I want to focus on the key slides, but these are the standard ones we share every time. So I'm going to share these ones. Here you'll see from a market cap attribution perspective, the market cap segments have performed more or less in line, with mid and small caps somewhat underperforming the large caps and causing a small hit to alpha. If you go to next slide, it shows that from a sectoral perspective, there's been greater divergence, and most of the sectors that we've been underweight have tended to do very well this quarter, and hence that's been a bigger hit. And we'll analyze that in greater detail in slides to come. This is for the quarter. Now, what you see here are the top performers and top detractors, but now, so Chola, Intellect Design, Cipla, and all have been top contributors, whereas Coforge, Indigo Paints, Nestle, and others have been detractors. So mostly IT companies and consumer companies have detracted in the portfolio. If we go to next slide, this is since inception. You'll see that despite a headwind from the market cap allocation, the overall performance has been strong alpha due to 33% outperformance over the last 3 years due to strong stock selection alpha in every market cap segment. Next slide, you'll see similar story despite, I would say, very minor headwind over the 3-year period, only -1, so can't really call it a headwind, but more or less all of the alpha, 34% out of 33% of alpha has come from stock selection. If you go to next slide, this shows since inception, alpha contributors and detractors. Not to go into individual names right now, but happy to revisit if anyone would like to talk about them. Next slide shows the longer term strategy performance, including performance prior to WhiteOak of the strategy that I have and the approach that I've always managed with, and what here the WhiteOak team is largely following. What this shows is very high degree of consistency over a 15-year period. This is representative performance, not necessarily precise on net of fee basis, but it's more gross. So those caveat to be kept in mind. 45 out of 60 quarters, so 75% of the quarters outperformance, 54 out of 57 rolling 1-year periods as measured every quarter end is positive, and then 100% strike rate on rolling 3-year and 5-year basis, approximately 900 basis points annualized alpha, 200 quarterly. So great degree of consistency, but obviously it's not 100% of the time. There are 25% of the quarters that have been underperforming, and a couple of years as well out of these data points. If we now go to the next slide and look at the distribution of performance over quarters, as you would expect, generally, this follows a normal distribution in terms of alpha. So what this is showing is that the first quarter underperformance is not unprecedented, but it is one of the rare events in looking at the past many years of performance. So the average alpha, as you can see in the middle, has been 2%, which is what we saw in the earlier slide as well. And this is, we've taken every month and 3-month rolling periods at the end of every month. So there are 166 data points, large enough sample. 2% average alpha quarterly, or 1.9% as it shows, net of fees, with a standard deviation of 3%, nearly 2.9 on a quarterly basis. So annualized, the alpha becomes nearly 8% net of fees. And actually the annualized tracking error is, because tracking error you cannot multiply by 4, but annualized tracking error is 6, right? But let's come back to the quarterly. So you'll see 2% average alpha at one standard deviation. And pardon me, this is a little bit too much statistics, possibly for many people. I'll try to simplify. But what it means is that one standard deviation means 66% of the times, which is 1 sigma, the alpha tends to be between -1 to 5% on a quarterly basis. As you'll see, the slightly darker blue bars here show, with an average of 2 and -1 to 5 is where most of the quarters outperformance is where it falls. 2 sigma is where 95% of the times the alpha is between -4% to +8% in the portfolio. Because 2 is average, -2 sigma means 2 minus 6, because standard deviation is 3. So -4, and then 2 plus 6 is 8. So -4 to +8 is where 95% of the time performance should fall, and it is more or less so, as you will see here. There has been an instance in a rolling 3-month period where performance was -5 in the past, though it is very, less than what statistically would be suggested, because you'll see there are several time periods, several instances of more than 8%. Alpha over a rolling 3-month period. In fact, there is an instance of 3 sigma on the positive side where we've generated 11% or more, it should say, of alpha. Though so far that's not been the case over any rolling 3-month period on the negative side. So what this chart shows is that underperformance, it's not the first time we have had underperformance, but it has been fairly rare. Very few times that we've underperformed at -3, -4, -5. In fact, if I eyeball it, 2 plus 2, 4 plus 3, 7 times in total where alpha has been -3 or more. And this time is also falling in this category. So now let's look at, now these are rolling month and periods. Okay. Now what we are going to look at on the next slide is the worst drawdowns over the last 10 odd years for the strategy. So this also includes intra-month periods. Okay. So it is worst of the drawdowns from maximum alpha to how much has been drawn down. And you'll see that over the last 10 years, there have been 7 instances of 4% or 3.9% and more, call it 4% and more, 2012, 2013, 2016. In fact, we had two such instances in 2016. 2018 was as big as, what it is still as of today or as of yesterday, minus 7.4. And then 2020 and now 2022. Pretty much every second year or less than every 18 months, more or less, I would say, there is some such instance. The reason it stands out this time is because the underperformance started pretty much from January 1st. So this, when it says December 21 to April 22, it is December 31st of 21 to January, to April, till a week ago. If it was intra-month or started in, let's say, like if you see in 2018, we had minus 7.4% alpha between May and September. But what happened was it started in May. So there was outperformance in April. And so that offset some of the underperformance for the June quarter. And then somewhere it stopped in September. And some of the outperformance in September would have also offset that underperformance. So over a peak to trough, it is 7.4, even though the year of 2018 was, I think of that as the best performance in my career, given the headwinds we had, and where we were the best, or pretty much the best, I don't know every other one, but of all multi-cap fund managers for the total full year. So 2018, it's very interesting. Despite having a 132-day period where we had minus 7.4% alpha, we ended the year positive alpha by 300, 400 basis points or so, somewhere north of 300 basis points. And it was an environment when almost, as many of you might recollect, almost every other manager had underperformed because it was the worst year for small caps that year, as small and mid caps. So the highlight here is of the first column is the time periods when it has underperformed. There have been 7 such time periods in the last 10 years. The drawdowns have ranged from 3.9 to 7.4% with an average drawdown of 5.5%. Typically, the duration of such underperformance has been nearly 3 months, is 85 days. And then the number of, on average, the number of days taken to recover this underperformance has also been 3 months at an average of 91 days. And if you look at from the worst point, and we don't know, by the way, I'm not suggesting we are right now at the worst point of this drawdown, but I'm saying in the past, from the worst point of the drawdown, the prior 6 times, the average outperformance of the strategy has been 13% relative to the benchmark. And over a 24-month period, it has been 27%. So well in excess of the average outperformance of 9%, 8 to 9% that we've had annualized. Again, there is no explicit or implicit guarantee. This is just statement of facts. Please don't take it as a projection of what we expect going forward, because it's not what we are expecting. If it comes about, that'll be great, but not certainly laying any expectation or projection. If we go to now the next slide, what we analyze here is to see whether there is, in the past alpha drawdowns, the 7 time periods that we talked about, including the present time, is there any particular factor that hurts us? Now, as many of you, if not all of you know, there are a couple of things that we tolerate as factor risks. One is that we have higher exposure to mid and small caps compared to large caps. And the other is that we are substantially underweight in certain sectors for reasons that we'll cover later. These are sectors like energy, utilities, generally speaking, metals, and also government-owned companies. And we generally, over the last 15 odd years, have been overweight in private sector financials and in consumer discretionary. So what the red bars here, so the blue bars are the alpha drawdowns when we've underperformed. So as you can see, minus 7.4 most recently, which is as of last week, not year to March, but as of last week. And the red bars are the headwind, meaning what is the performance of this underweight sector or our overweight sectors, which is financial and consumer discretionary, compared to our underweight sectors. So as you see, the overweight basket is private banks and consumer discretionary. Underweight basket is PSUs, energy, metals, and utilities. Interesting, as you'll see, that every underperforming time period, the big major drawdowns, each of the last 7 drawdowns have been during time periods or have coincided with time periods where our overweight sectors have substantially underperformed the underweight sectors. Again, this is not an excuse or anything. This is more a statement of facts. And it so happens that this time around, that underperformance of the overweight sectors or the outperformance of PSUs, energy, metals, and utilities is most acute. They've outperformed financials and consumer discretion by 26%. The last time it was, the worst data point is 16.6%. So it's very acute underperformance over the last 3.5 odd months. If we go to next slide, then this shows what has happened over the next 12 months. As we shared earlier, the portfolio average outperformance was 13%, which is shown again in dark blue bar. Obviously, its average is 13. Sometimes it's as strong as 23% in 2020, and sometimes it's as low as 1.1% in 2012. But the important point I want to highlight here is that to outperform then over the subsequent 12 months, we don't necessarily need our sectors like financial and consumer discretionary to outperform the other sectors. As you'll notice here, out of the 6 periods in the past, because 7th period is currently, we don't have the data, obviously that's going forward. But out of the 6 past instances, 3 times in 2013, 16, and 20, actually the overweight sectors have continued to underperform. In fact, in 2016 by a huge margin. And the other 3 times they have helped by outperforming the other sectors. The key takeaway here is that the subsequent recovery does not require reversal of the sectoral performances in the benchmark, right? As you see here, half the time it has and half the time it has not. More or less the average is close to 0. If you go to the next slide, this shows now performance over the last 10 years of the strategy. Outperformance of nearly 100% from March 12 to March 12 to April or March 31st, 22. You'll see that alpha has gone from, the alpha index is 198, meaning 98% net alpha. What you see in the red line is the relative performance of the overweight sectors versus the underweight sectors. So during this entire time period, our overweight sectors have actually substantially underperformed the underweight sectors because 100 has become 61. Below 100 means financials and consumer discretionary underperforming the other PSUs and all that I mentioned. So over a long period of time, even if the sectors have substantially underperformed, still our stock selection has been so strong that we've been able to more than offset, not just more than offset, we've delivered top ranking performance compared to peer group, very much at the top end, if you will. You'll also notice the red line, what is highlighted, the 2 vertical gray lines, what is highlighted is the COVID, the first gray line is going into COVID. There was strong outperformance of financials and consumer discretionary or underperformance of the metals and PSUs and all, such that the index went to 132. From 132 to 61, there's been, a 50% drop in that, or in a way 50% reversal or underperformance of those sectors compared to the utilities, metals, and whatnot. And yet over this 2 years and a quarter time period, alpha has been positive, not huge, but 187 has gone to 198. So added 10 plus percentage points of alpha. It's just that this last 4 months, the the sectoral risk, the sectoral risk has been very powerful, very sharp, and has created an unprecedented headwind, as we show in the prior. So the importance of this slide and the prior slide is to drive home the point and dispel the misperception that for our strategy to do well, these sectors have to do well. That's not the case. It's just the sharp difference needs to smoothen out and not necessarily reverse. If you go to next slide, please. One interesting slide. This is simply the 10 best performing companies and 10 worst performing companies of the top 100 market cap companies year to date. You'll see on the left-hand side, top 4 are utilities: Adani Power, Adani Green Energy, Adani Transmission, and Adani Total Gas. And then it's a metal company, Jindal Power and Steel. Chola is the only financial, which, by the way, is one of our top companies in the portfolio. Then you have 3 PSUs, Bank of Baroda, Hindustan Aeronautics, and Coal India. And you have an industrial company, Adani Enterprises. So of these 10, you'll see they're mostly utilities, metals, or government-owned companies. Only financial happens to be the one that we own in fairly good size. Whereas on the underperforming ones this year, 5 or 6 have been IT services, and others have been in the consumer space, with some one financial as well. So very sharp divergence that you seen that I shared with you on the sectoral slides. It also is, just illustrated by the top 10 performers, where some of the utility names are up more than 100%. The utility index itself is up 40%. And some of the PSU names and all have in the top. Now, if we go to next slide. So you may wonder why we don't own much in these sectors, the government-owned companies, utilities, commodities, and so on. First, I want to share with you our portfolio construction approach, which many of you would remember, is to have a balanced portfolio that avoids top-down market timing or sector rotation kind of bets, aims to generate alpha through stock selection. As the 4th bullet point suggests, we don't necessarily seek to zero out every non-stock specific risk. Any sector underweight or overweight is a non-stock specific risk. We don't seek to zero out, but we monitor them and aim to contain such risks which are byproduct of stock selection. The right-hand side graphic, won't go into it in detail now, but basically if you think of the dotted line as some kind of a market cycle, from stock selection perspective, you only want to buy companies that fall above the x-axis over a cycle. We make some mistakes as well, but let's say if we are doing more right than wrong, we'll generate the double-sided arrow line as outperformance. Within the portfolio, we seek to have pro-cyclical names, which are depicted by the dark line, and counter-cyclical names like staples and pharma, the light line, such that we have a balanced portfolio. If we go to next slide, it talks about first of the 2 major factor risks that we tolerate. Notwithstanding what I talked about, balanced portfolio, we do tolerate some major factor risk. One of them, first of them, you can say, is the very obvious, is that we do own as a flexi cap strategy benchmark against a BSE 500, and with 40% in mid and small cap, we about 20% overweight in mid and small cap pretty much all the time, plus minus few percent. So there is a factor risk of size. If mid and small caps do terribly, like in 2018, we would tend to have a headwind, right? And at other times, like 2017 or 2020, when mid caps do very well, we'll have a tailwind. Over time, it doesn't matter, really, it evens out. Nobody can, by the way, despite what anyone says in media or in investment circles, we strongly believe you cannot time which market cap segment is going to outperform versus others. So people talk about small caps are looking more attractive, mid caps are attractive, large caps are attractive or not attractive. All that is just mere talk, and there's no substance really in our view. Now, the reason then we have more in mid and small caps is because they are more inefficient segments of the market, as you'll all agree. So if you do your research well, you can generate huge alpha in mid and small. Large caps tend to be better researched and have less inefficiency. Still, alpha can be generated, but to a lesser degree. And it is, we have 15 years of empirical evidence that of our own to confirm that. Hence, we do allocate from, obviously you can't just manage a small group, too risky a portfolio can only be a small part of anybody's allocation. We have a flexi cap where we have over time with 60-40, 60 large cap, 40 mid and small, delivered very top-notch performance. So this risk has been well tolerated and well understood. So the reason to own more mid and small cap is not because they're undervalued or overvalued. As we show here, we believe at all times, each market cap segment is reasonable to assume that is relative to each other fairly valued. If we go similarly to next slide, it's a little bit busy slide, relatively new slide, which I don't think many of you have seen before. But what this tries to show is the rationale for our sectoral underweights in some of the sectors that I talked about. So the way to think about it is, forget about now the small cap, mid cap, large cap. But just bear in mind, we put more in small mid because there has more alpha potential. Similarly, given our philosophy and approach, there are certain sectors which provide more opportunities for alpha generation. So all sectors, first of all sectors we believe are fairly valued. You cannot say, just like you cannot say large caps are overvalued or mid caps are undervalued and all that. Similarly, we find it very, illogical to say sector as a whole is overvalued or undervalued. There are companies within sectors that will be overvalued or undervalued. Having said that, there are certain sectors which lend themselves to a greater number of alpha generating opportunities. And there would be similarly great number of opportunities which would lose money in those sectors, but dispersion is wider. It cannot be called inefficiency, but yet the dispersion is wider. Like on the green side, you'll see sectors like IT services, FMCG and all, and then financials, consumer discretionary and so on. On the other hand, there are sectors which do not lend themselves to alpha generation from a stock selection perspective. And I'll explain that a little bit more. These are sectors like commodities and real estate. Now, what are the, just like market cap was the function in the previous slide, what here the factors are, as you'll see in the box, poor governance, macro variables driven, or heavily regulated sectors. These kind of sectors, in our assessment, present lower opportunities for alpha generation. They're all fairly valued. We are not saying that they will underperform. We are just saying that the alpha generation opportunity is lower. Doesn't mean that some of those stocks would not substantially outperform. What we mean is that ex ante, it is not possible to apply logic beyond a point to understand and invest for that alpha. On the other hand, sectors which are very well governed. So let's take each one step by step. Poor governance versus good governance. Why does good governance leads to greater opportunity for alpha generation? Because see, when governance is good, let's say in IT services companies in general, that is for 90% of the IT services companies, that's true. So if you do your work, analyze companies properly, analyze managements and everything, and project cash flows, you can have confidence. See, when you're investing in a company, let's say we own 5% of a certain company. And since it's a closed circle, we can say, let's say we own 5% of persistent systems. Now, persistent systems has very good governance. Over time, it's had other problems, but people have not blamed it for governance. So when companies with good governance, if we own 5% and we have certain estimates of future cash flows, it means we as investors would get 5% of those cash flows over time in the form of dividends, stock buyback and whatnot. In case of poorly governed companies, and I'll avoid mentioning particular names, but let's say most of the real estate companies would fall. Again, we have put a caveat here on the right-hand side as a note. It's just a graphical representation for illustration and not supposed to be precise or accurate. For example, not all real estate companies are poorly governed or crooks, and not all IT companies are well governed or saints. Okay, so please don't take it to mean that we are suggesting all IT companies are great. We've had great frauds over the last 5 years itself, and we've successfully avoided amongst IT companies, not to mention the names here. And similarly, in real estate companies, there are names like Godrej and Phoenix Mills and some others which are very well governed. But we are talking more generally, 80-20 rule or 90-10 rule. So in case of a poorly governed real estate company, if you were to think of, even if you're right about what cash flows the business would generate, if the management is crooked, then those cash flows would be diverted or siphoned off one form or another, and you would never see your 5% or your rightful share of cash flows. So in that case, no matter how much research and analysis you do and how much upside there is, and in the business, you won't benefit because the controlling shareholder will siphon off disproportionate share of the value. And that's why. And there's no formula. The crooked management would not give you a formula that we will only siphon off 25% of the cash, which you can put in the model and then value it 25% less. Sometimes they'll siphon off 80%, 90%, or more than 100%. And over time, you don't know how much they'll siphon. And so these companies are best avoided. Whereas in case of good governance companies, you find great businesses to invest. Similarly, certain companies are, and I'm not going to name every company that is or sector that is poorly governed. I assume that investors by and large have enough understanding here on the call of what companies there may be. There are certain companies we are driven predominantly by macro variables. Let's say metal companies. What the value of a steel company is driven predominantly by the price of iron ore if they have captive resources, and the price of steel and the difference between. Right? And steel, iron ore, these are macro variables that we believe, just like the market cannot be predicted, similarly, these macro variables are inherently unpredictable. And so are oil prices. People have gone flamboyantly wrong. The best experts go flamboyantly wrong in predicting these macro variables, and nobody has any predictive power, is our belief. So there it's like shooting in the dark. Whereas again, if I take, let's say for timing, persistent as an example, here you can analyze business variables. That yes, they have good technical capabilities, always had good technical capabilities. The management wasn't so strong, but now with the new CEO, that problem is fixed. And so you have strong technical capability combined with strong management and sales capability, and they should be able to catch up with their run rate potential, trend line potential. They've underperformed over the last many years because of poor sales capability. And now the new management will help them catch up with their potential and grow at a faster trend line. These kind of analysis in metal companies doesn't matter. How many steel companies can you see? Can you say that a good management would help turn around the fortunes? If it is terribly a shoddy company, they may bring it to average. But otherwise, in commodity companies, it's mainly the commodity price, global commodity price, which is a unpredictable variable. So we tend to not have such business investment in such businesses where it is unpredictable variable is driving the value. And then sectors, areas where it's heavily regulated, we tend not to invest, again for reasons that should be quite obvious. Sectors like IT services, FMCG are more regulated. Because heavily regulated, macro variable, poor governance, by the way, they often tend to go hand in hand in some of the sectors that we don't own. Real estate, by the way, is heavily regulated at local level. So you guys understand what I'm trying to say. So those are the reasons. It's not, again, I repeat again and again, that it's not that we believe this poorly governed, macro variable driven, heavily regulated sectors would underperform over time. They, by the way, at this time, let's say loosely speaking, make up 25% as number of names of the market. It's not that we are saying they would underperform. It's just that what makes them tick, what makes them work or not work, are not variables that one can assess. They're more random and unpredictable. And over long periods of time, investors who invest in these kind of companies would not necessarily underperform, but unlikely to outperform. They'll be more or less in line with the market over extended periods of time. Whereas we are not in the business of just being in line with the market. Our investors expect from us, and I expect from the team, and the team expects of itself, to deliver strong alpha over time. And hence we tolerate the risk of not blocking 25% of our portfolio, roughly speaking, in this red segment, if you will, but focus more on the other two segments. And within that, the better governed companies and the better business models with the characteristics that I talked about. So I hope was able to explain the portfolio construction rationale for being underweight these sectors. Happy to answer questions in Q&A, but if we go to the next slide now, in the interest of time, portfolio composition today remains, and there are other aspects I've not fully covered. So from a risk mitigation perspective, from sometimes we would invest, like we have invested recently from a risk mitigation perspective in Hindalco and Tata Steel. So when this sector has outperformed by like 300%, right? The weight of the sector, or this sector has gone up 300%, has outperformed by more than 100%. The weight of the sector has doubled and the volatility has quadrupled. So the value at risk, if you will, has jumped up substantially. So we have put small positions in Tata Steel and Hindalco, partly to mitigate the risk of the Russia-Ukraine war getting out of hand and very heavy sanctions lasting for very long, and runaway inflation. If that kind of situation were to happen, then from a portfolio construction and risk management perspective, we have invested about less than 3% of the portfolio in an area where we believe the alpha is small, alpha potential is small, but it does help us substantially mitigate risk at this time. So I just want to say there is a caveat to everything that I say. And this was one that I just realized as I was looking at the sectoral weights, and happy to expand on that. But you'll see the sectoral weights, as is usual with the past. We don't own anything in energy and utilities. We have greater allocation in relative to the benchmark in IT services, consumer discretionary, and on the whole in banking sector, which I'll just quickly turn over to Parag before that. But I'll say from a market cap perspective, you'll see we remain at about 60% large cap and 40% mid and small cap put together. I want to turn it over to Parag to cover in a few minutes the most important corporate India development in a long time, which is and which many of you might have questions on as well, as it's a portfolio holding as well, which is the merger announcement of HDFC Bank with HDFC. We do own HDFC Bank, not the parent, but want to turn it over to Parag for our views on the same. Parag? According to us, it is neither a big negative nor a big positive. We are more neutral on the merger. If executed well, it can be a small positive longer term, a small, depending on execution, because it's a massive, gigantic merger. Two of the largest financial services institutions. If executed well and synergies exploited, it can be a material positive, not runaway positive, but significant enough positive. What are the synergies? So HDFC parent, the mortgage company, has a very large customer base. Only a fraction of it, a minority fraction of it, I think somewhere in the vicinity of 25-30%, are existing clients of HDFC Bank. So it opens up a huge customer segment for HDFC Bank to tap in and cross-sell large variety of other services that and products that HDFC Bank has to offer. So at the closure of the merger, all of a sudden, you have a huge customer acquisition event that has materialized for HDFC Bank, which would take otherwise a lot of investments and a lot longer time for HDFC Bank to. So I'm talking purely from HDFC Bank's perspective right now, because that's the position we own, and not as much from HDFC's perspective. So the biggest benefit for HDFC Bank is this. The other second benefit is, HDFC parent had an implicit holding company discount, which is quite material. It also owned some 20+% of HDFC Bank stock, which will be extinguished now. So that holding company discount going away. Yeah, Parag, are you there?
Yeah, I'm back.
So please take it away. I have just, so as to, you can spare the repetition to investors. What I've covered is, it's neither a big positive nor a big negative. If executed well, can be significant, if not runaway positive, but some significant positive. And the biggest benefit is the customers of HDFC now becoming available to HDFC Bank for cross-selling. But please continue.
Yes. Thank you, Prashant. And sorry, everyone, for the hiccups. Like what Prashant mentioned, that there will be, at a merged entity level, there will be a lot of cross-sell opportunity for the banking and financial service product to HDFC Limited customers. So currently, the HDFC Limited customers just take the home loans and probably an insurance and just get away with that. Rather you can then cross-sell a lot of other products like banking, saving accounts, wealth management to those customers, which can benefit the combined entity. There will be a very reasonable cost synergies due to large-scale operation of a combined entity. At a combined entity level, the cost-to-income ratio of HDFC Limited is extremely low, which once merged into HDFC Bank can benefit the combined entity. Lastly, as Prashant also mentioned, that there is a holding company discount. So HDFC Limited owns around 22.6% of HDFC Bank. Once you merge these two entities, the holdco discount automatically goes away. So that kind of benefit the shareholders. So these are the broader advantages or pros to merging both the entities. So although as Prashant highlighted, the merger is transformational and it's very exciting, there are challenges as well, right? As the banking regulation says that the bank, any bank which is which is operating in India, have to compulsorily maintain CRR at 4% and SLR at around 20-odd%. So incoming book of HDFC Limited is required to maintain the CRR and SLR. And I would like to note here that on CRR, the bank don't earn anything. And on SLR, the yield is generally 2 to 3% lower than the loan yields, right? So this will kind of drag the overall profitability. In addition, the combined entity will also have to require compulsorily maintain 40% as a priority sector lending targets. These are the lending which is given to the weaker section, the small and marginal farmers, affordable housing, etc. So combining these two, the statutory requirement of SLR, CRR, as well as the priority sector, will kind of drag the return ratios in the very short term, say about 1.5 to 2 years after the merger. In addition, so if you look at the combined entity, once you merge HDFC and HDFC Limited, they will kind of create 16.5% of the total banking system, right? Which would be next best to State Bank of India, and probably ICICI Bank will be distance third now with a 7.5% market share. There are always challenges with respect to future growth potential, because at at probably 1/6 of the banking system, how much you can grow above the industrial level. So that's also one of the challenges which remains for the HDFC Bank's management to address. But however, if you look at HDFC Bank's management's execution track record, it is quite phenomenal, and we believe that they will be able to overcome a lot of this short-term opportunity. Right. Overall, I think merger will be neutral to positive in the long run if the management is able to execute of cross-sell, bringing the cost synergies while limiting the drag, which will be there on the profitability due to statutory requirement. So I think that's all about HDFC and HDFC Bank's merger. Probably we can take some of the questions in Q&A. But before that, I will probably hand over back to Prashant.
Thank you, Parag. Am I on?
Yeah, Prashant, you are on.
Okay, so great. So just as Parag pointed out, near term, some hit to profitability as they scale up the CRR, SLR. But if they execute well, then longer term, probably the growth opportunity from cross-sell should help offset that near-term hit. So execution would remain key. If we now, having covered the portfolio composition and HDFC Bank, we can now go to some of the questions on top of people's mind and might be able to address them in detail if there are further questions. But one of the most frequently asked question to us is what happens now that the Fed has started hiking rates? Will liquidity get sucked out? This, that, and the other. I think you all probably at some point or another have heard from us that we don't pay much attention to these macro variables because they don't mean anything, and there's no empirical evidence, is what we've been saying. There's no whatsoever, none, zero empirical evidence in the past to suggest that such loose talk can help people make money or help people avoid losing money. And so we came across this in doing some more work. We came across this data, which shows that in the last 5 times that Fed has embarked upon raising rates, going as far back as March 1988, nearly 25 or 35 years ago, 5 times, 88, 94, 99, 04, and 15. After the first Fed hike, which is what we've already had, the forward 12-month return for Sensex has been 20%, more than 20%, which is nearly twice, if not twice, at least, compared to the average over this time, must be 13% odd return from the market. So 20% return, very robust return on average. And even US market has delivered in dollar terms 7% return, which is in line with its longer term average return that US market has delivered. So there is no empirical evidence. If anything, the evidence suggests or is contrary to the widely held superstition that Fed hikes mean poor returns from the market. Again, we don't have any view. We are not suggesting the markets would do it very well or something. It's like, if you have a superstition that if a black cat, like most cultures have this superstition that if black cat crosses the road, something evil is going to happen. We are not saying that something good is going to happen. We are just providing some empirical evidence to say that at least on average, after this black cat event, there's no negative that has happened empirically in history, as per historical empirical evidence. Happy to answer any questions. Now, if we move to the second most frequently asked question, which is Ukraine invasion of Russia and the consequent rise in oil prices. We all know India imports a lot of oil. That is a negative to the country, but it's not the first time that we've seen this. Over the years, oil as a percent of GDP at a certain price has continuously gone down. So if you see at the start of the century, a $60 oil price equated to 3% of the GDP. Today, $100 stock oil price equates to 3% of the GDP. However, it is true that every $10 increase in oil price does have, by some estimates, again, we've not computed them, a 35 to 50 basis points negative impact on CPI, GDP, and current account deficit. So a $30 odd increase in oil price, $30 to $40 oil price increase would be in a way 65 billion additional net imports, which is roughly 2% of India GDP. A lot of people, I think, have made it out to be far bigger in perception than what it is. Remember, the COVID hit, and if you go to next slide, the lessons from COVID, if you were to just remember 2.5, not even 2.5 years ago, at the start of 2020, we all were debating whether India's growth is going to be 5%, maintained at 5%, or can accelerate to 6% or decelerate to 4%. And what are the implications for the market? With the underlying assumption that if it is 4%, market would do poorly because corporate earnings would be hit, and 6% would do very well, so on and so forth. The actual number for 2020 was minus 7.5%, and the market delivered positive 35% return. Right. So the lessons, which COVID year was the best year to learn lessons from the market. And we've written a newsletter on that. Please strongly recommend everyone to read that 2020 newsletter called Macro Shakro. But the lessons, again, that the usual perennial macroeconomic worries of well-known, unknown varieties, which is whether GDP growth will be a percentage point higher, lower, this and other, has hardly any influence on returns from equity, if at all. Second is that nobody has crystal ball on cataclysmic risk events like the pandemic. But even if you were to know exactly what's going to happen in the real world, you cannot draw any conclusion about the market. If you had known everything that was going to happen in the real world with the COVID pandemic, you would be out of the market and miss out one of the best rallies in the last couple of decades. And third most important lesson is that any investment decision bereft of bottom-up analysis and driven by such macro consideration is fraught with high risk of substantial absolute and relative loss. Again, as many people made the mistake in March 2020 of cutting down or exiting their equity investments would relate to